Imagine waking up one morning, checking your bank app, and finding out your money's still there, but suddenly worth half as much. No war, no zombie apocalypse, just economics doing what it does best, quietly setting the world on fire while pretending everything's fine. Sounds crazy? Well, that's exactly how people felt right before 2008, and how they'll feel again, only next time it's going to be much, much worse. Because the next financial crisis isn't just another bubble pop. It's the grand sequel, the 2008 Crisis Extended Universe, and every hidden ingredient that once nearly collapsed the global system has now been supercharged. To understand how we got here, we have to go back, not to 2008, but to 1971. That was the year money stopped being real. When President Richard Nixon ended the gold standard, he didn't just close a chapter in financial history, he deleted the very concept of value. From that moment, money became, well, an illusion backed by promises and printing presses. It was supposed to make things flexible. Instead, it made money the most addictive drug ever invented. Since then, every time the economy sneezed, governments handed it another dose. Low interest rates? Boom. Quantitative easing? Boom. Bailouts? Triple boom. It's like giving an overworked heart caffeine instead of rest. It'll beat faster, sure, until one day it just stops. And here's the plot twist most people don't know. The 2008 crisis never ended. It was just patched up, like putting duct tape on a sinking submarine. The debts, the risky bets, and the moral hazards, they didn't disappear. They evolved. Remember 2008? When fancy words like subprime mortgage, credit default swap, and too big to fail became the soundtrack of panic. Banks were giving out loans to people who couldn't afford to pay them back. Investors packaged those loans, sold them to other investors, and everyone pretended they were gold. Then reality showed up like, hey, these people can't pay their mortgages. And boom, trillions of dollars vanished overnight. The economy froze, the stock market crashed, and millions lost homes, jobs, and hope, while a handful of bankers got bonuses for surviving. That's not capitalism, that's financial theater, and the actors never left the stage. Fast forward to today. We tell ourselves we learned from 2008, except we didn't. We just swapped the names of the villains. Back then, the problem was real estate. Now, it's everything. Corporate debt is at record highs. Government debt makes the old numbers look like spare change. And consumer debt? Let's just say, well, people are buying iPhones with credit cards that they also bought with credit cards. The system didn't heal, it mutated. In 2008, the fire started in Wall Street. In the next one, it might start everywhere at once. Because today's risks aren't just financial, they're systemic. Global supply chains are fragile. Inflation is wild. AI-driven trading moves markets faster than humans can blink. And central banks? They're walking a tightrope while juggling fire. If they raise rates too fast, boom, recession. If they cut too soon, boom, inflation. Either way, something's going to boom. And here's the sick joke. Everyone thinks they'll see it coming this time. They won't. Crashes never send calendar invites. In 2023, Silicon Valley Bank collapsed in just 48 hours. 2 days. That's all it took for one of the most innovative banks in America to vanish. People said it was an isolated case. Spoiler, that's what they said about Lehman Brothers too. Because every financial disaster starts as contained until it isn't. Behind the scenes, small dominoes are already wobbling. Commercial real estate is crumbling under high interest rates, banks are sitting on mountains of unrealized losses, and governments are running trillion-dollar deficits like it's an Olympic sport. But don't worry, every expert on TV says it's fine. which historically is how you know it's not fine. They said housing prices would never fall. They said the banks were well capitalized. They said inflation was transitory. And they were wrong every single time. The truth is, we're living in the most over-leveraged, overconfident, overprinted moment in human financial history. And the pressure is building. Think of the global economy like a fault line. For years, tiny tremors have been building under the surface. Debt, inequality, speculation, greed. Every rescue plan, every bailout, every interest rate cut is just another layer of tension. And sooner or later, fault lines don't negotiate. They break. And when they do, the shockwaves won't just hit Wall Street, they'll hit you. Your savings, your rent, your job, your future. Because this time, the problem isn't in mortgages or tech stocks, it's in the money itself. If you're hooked so far, imagine what's coming next, because the deeper we dig, the scarier it gets. Hit that subscribe button so you don't miss the rest of this wild money story. We're just getting started. Up next, we'll uncover the real reason economists are terrified, the invisible machine that keeps the global economy alive, and why turning it off could send us back to the financial dark ages. This is where things get truly dangerous, because the next crisis won't just be about losing money, it'll be about losing trust.
So, what exactly is this invisible machine that keeps our global economy alive? It's not gold, it's not oil, it's debt. Debt is the lifeblood of modern civilization, the oxygen of growth. Governments borrow to fund themselves, corporations borrow to expand, people borrow to exist. Your home, your car, your degree, your phone, even your coffee habit. Somewhere in that chain, someone's borrowing money to make it possible. It's a beautiful system, until everyone tries to exhale at once. See, the world economy runs on a delicate illusion that debt will always be paid back someday. But here's the uncomfortable truth. It won't. It can't. The total global debt is now over $300 trillion. That's more than triple the world's entire GDP. In other words, if every country, business, and human worked for free forever, we still couldn't pay it all back. So how does the system survive? By never stopping the borrowing. It's like keeping a shark alive. It has to keep swimming, or it dies. And if global debt ever stops growing, the economy doesn't stabilize, it collapses. But don't worry, governments have a brilliant solution. Whenever the economy slows down, they just print more money. It's like giving a patient with heart failure more sugar. During the 2020 pandemic, the US printed over $5 trillion in new money. The global total? Around $13 trillion. And that, my friend, is how you turn a virus into an inflation explosion. Prices soared, but politicians called it stimulus. People felt rich until they realized their extra money bought them less of everything. That wasn't growth, that was a magic trick. And the magicians running out of rabbits. If this sounds familiar, that's because history's been here before. In the 1920s, cheap credit fueled a global boom. Everyone was partying, stocks were soaring, debt was easy, and optimism was infinite. Sound familiar? Then came 1929. The Great Depression wasn't just about a stock crash. It was about too much leverage collapsing under its own weight. The scary part? Today's leverage makes the 1920s look like pocket change. We've built a financial skyscraper on a foundation of IOUs, and we just keep adding floors. What makes the next crisis uniquely dangerous isn't just the numbers. It's the interconnection. Every system, banking, housing, tech, crypto, supply chains, is now woven together. One sector trembles and the shock travels instantly. Imagine a spider web. Global finance is that web. And every strand is stretched to the limit. When one corner snaps, the whole web shudders. That's why the next meltdown won't look like 2008's slow-motion car crash. It'll look like everything breaking all at once. Right now, asset prices everywhere, stocks, houses, crypto, art, even sneakers are inflated beyond reason. Why? Because for over a decade, money was practically free. Low interest rates made borrowing irresistible. Companies borrowed billions to buy back their own shares. Investors piled into anything that promised returns. And consumers joined in because why not? Debt was cheap. But when money stops being free, the hangover begins. Interest rates rise. Loans get expensive. Defaults begin. Confidence cracks, and suddenly what looked like wealth creation turns into wealth evaporation. But there's an even darker layer. You remember those derivatives that caused chaos in 2008? They never went away. In fact, they grew a lot. Today, the global derivatives market is estimated at over $600 trillion. That's $600 trillion worth of financial contracts, all dependent on assumptions like interest rates will stay stable, currencies won't swing too wildly, and everyone will keep paying their debts. Spoiler, they won't. If one of those assumptions breaks, the domino effect could make 2008 look like a warm-up drill. Imagine the entire economy as a giant game of Jenga.
In 2008, we lost a few blocks at the bottom. Scary, but we rebuilt. Now, the tower is taller, wobblier, and made of even flimsier blocks. Everyone knows it'll fall. They just hope it happens after their bonus. But here's where it gets existential. Money isn't metal or paper. It's trust. Trust that your bank will hold your savings. Trust that your government won't inflate your money away. Trust that tomorrow's economy will still function. When that trust erodes, the system doesn't just shake, it implodes. And that's why the next crisis will be worse. Because we're not just short on money, we're running out of belief. People don't trust banks. They don't trust government. They don't even trust currencies anymore, hence the rise of crypto, gold, and digital escapes. But even those aren't immune. Crypto, volatile, gold, safe, but static, and governments, printing like it's a contest. The truth is, there's no clean exit. The global system has reached a point where every solution just creates a new problem somewhere else. Raise interest rates to fight inflation, you risk crashing the economy. Cut rates to save the economy, you stoke inflation again. It's like financial whack-a-mole, only every mole has a mortgage. Every great empire, Roman, Ottoman, British, collapsed not because of war or invasion, but because of money. Corrupted money. Debased currency. Too much debt. They all thought they could outsmart math, and math always wins. Today, we're watching history repeat, but with Wi-Fi and smartphones. The fall won't look like soldiers at the gates. It'll look like red charts on your screen, empty ATMs, and markets temporarily halted for volatility. So what happens when this system finally breaks? We'll likely see massive bank consolidations, digital currencies replacing cash, governments stepping in with rescue programs that quietly take away more control. The next crisis won't just reshape wealth, it'll reshape freedom. Because when trust collapses, people look for control. And when control comes, freedom goes. But remember, crises aren't just charts and numbers, they're human stories. Families losing homes, jobs disappearing overnight, people realizing the system they believed in was built on sand. And maybe, just maybe, that realization is what resets everything. Financial history is a cycle. Boom, bust, repeat. But every crash leaves behind a clue, a warning carved into time. 2008 told us If you ignore risk long enough, it will eat you alive. The next one will tell us something even harsher, that you can't solve a debt problem with more debt. And yet, that's exactly what we're doing. If you loved uncovering this hidden side of financial history, hit that subscribe button and join the Money Archive. Because understanding these patterns isn't just fascinating, it might be the only thing that saves your wealth when the next crisis hits. And here's the question that keeps economists awake at night. If the last crisis was about banks being too big to fail, what happens when governments become too big to save? That, my friend, is the story we'll uncover next.